Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. We are diving straight into the analysis of Q2 2026 performance, and wow, the sheer momentum behind this company is demanding attention.
He really is.
We're reviewing the most impactful topics from the corporate reports and really focusing on the mechanics of acceleration. This isn't just steady growth,
No, not at all.
It feels like a company fundamentally reshaping its entire operational model just to capture this AI boom.
That's exactly it. That's the core takeaway from all the material. Massive, deliberate acceleration. And it's driven by an aggressive and, frankly, a risky commitment to the cloud infrastructure market.
So let's put some numbers on that. Where did the top line land?
If we look at the high-level metrics, total revenue growth came in at 13%.
13%. And that's significant because this is a pattern now, right?
Exactly. It marked 3 consecutive quarters of double-digit growth. That proves this momentum is, it's deeply rooted. This isn't some kind of fluke.
And the cloud business, which is really the epicenter of this entire shift, it's no longer just a peripheral driver. It's now a full half of the overall revenue.
Precisely. The combined cloud revenue, that includes both infrastructure and applications, it hit $8 billion.
$8 billion.
And that's showing a year-over-year growth rate of 33%. That's a powerful number on its own, but the metric that truly defines the company's future, and the one that had analysts just doing double takes, is the remaining performance obligations, the RPO.
The RPO figure it's truly unprecedented. I think that's fair to say. It's what everyone is talking about.
It is monumental. RPO ended the quarter at $523.3 billion.
Okay, just say that number again. $523 billion.
Billion. And to put that 433% increase year over year into perspective, that's not growth. That is a complete transformation of their contracted backlog.
Right.
This isn't just steady accumulation. This is the sound of major strategic customers locking in massive multi-year capacity agreements.
Okay, let's unpack this RPO figure because, ultimately, it's the most important leading indicator we have. We're talking about $68 billion in new RPO.
Signed in Q2 alone.
In a single quarter. That's a mind-boggling volume of business. And what really stood out to me was the shift in who is driving this.
Yes, the diversification is critical. Historically, a big enterprise software company might rely on a few massive traditional client renewals.
Sure, the usual suspect.
Right, but now these contracts are being fueled by these massive strategic deals with hyperscale AI innovators and cloud natives. We're talking companies like Meta and NVIDIA.
And that proves two things, doesn't it?
It does. First, that their infrastructure, OCI, is genuinely competitive at the highest level. And second, that they're successfully pivoting toward the new highest growth customer segments out there.
But the financial market is always looking ahead. So while $523 billion in total backlog is impressive, the crucial factor for revenue is how quickly that cash will actually flow. What does the speed of that conversion look like?
And that's where the analysis moves from, just impressive to highly compelling. If you look at the near-term RPO, the portion they expect to recognize as revenue in the next 12 months, it grew 40% year over year.
40%. And what was that number before?
Last year, that same rate was only 21%.
So it's doubled.
It's basically doubled. A 40% growth in near-term revenue visibility suggests this massive backlog isn't some long-tail promise. It is scheduled for extremely fast conversion into recognized revenue. They're confident they can deliver the capacity quickly enough to start billing almost immediately.
So velocity is the name of the game. If they're signing contracts at this speed, what is the tangible financial implication for the next fiscal year? How does this translate into a hard forecast?
It translates directly into new firm revenue expectations. This rapid contracting means they're now expecting $4 billion of additional revenue in fiscal year 2027.
Additional revenue that wasn't even in their models a few months ago.
Exactly. That $4 billion is a direct quantifiable result of this RPO backlog acceleration.
But, of course, growth at this pace is not free. Delivering $500 billion worth of highly complex AI services requires massive, immediate capital deployment. That creates a huge logistical and financial problem.
It absolutely does, and we see the direct evidence of that in the CapEx forecast. Compared to their Q1 forecast, the projection for full-year FY 2026 CapEx had to be revised upward.
How much?
By $15 billion, and the sources are crystal clear on this. This entire massive $15 billion revision isn't just opportunistic, it's a necessary expenditure.
It's directly tied to fulfilling those new contracts.
100%. It's for acquiring the land, the power, the servers, the GPUs, everything required to fulfill the $68 billion in new contracts they just signed. And I can't recognize the revenue until the infrastructure is delivered, so this CapEx revision is basically proof of execution.
It's the highest stakes game of global supply chain coordination we've seen in the tech industry in years. So let's transition into the actual engine driving all of this, the cloud infrastructure business, or OCI. If the overall cloud revenue is up 33%, OCI seems to be the runaway hypergrowth segment.
OCI is the gravitational center of this whole story. Cloud infrastructure revenue was up 66% year over year.
66%.
And that rate is critical because, as the materials emphasize, it is significantly faster than the growth rates reported by competitors in the hyperscale market.
And this is the part that most directly reflects the AI feeding frenzy.
Absolutely. You see it right in the GPU-related revenue, which surged by an incredible 177%.
177%.
That specific figure tells you that the biggest players in the AI race are not just, kicking the tires on OCI. They are betting their most critical, performance-intensive workloads on it.
That GPU growth is certainly proof of the AI boom, but I find it much more interesting that the growth seems diversified. It suggests OCI has differentiators beyond just having a lot of chips.
That's a great point. What's fascinating is that the 66% pursuit OCI growth is not a monoculture. It's not built on one customer or one region.
Right.
The growth is spread across 3 distinct areas: supporting traditional cloud natives, delivering dedicated cloud regions to governments and large firms, and multi-cloud initiatives like that highly publicized interconnect with Microsoft Azure.
So that diversity proves its architectural flexibility.
It does, and it's also crucial to remember that OCI differentiates itself from other hyperscalers because it offers that unique combination of infrastructure and highly specialized applications. They're selling a full, deeply integrated software and hardware stack,
Which is a completely different value proposition for a customer compared to just buying raw compute from a competitor.
Yeah.
But let's talk about that raw compute for a second. To satisfy $68 billion in new contracts, they must be scaling their physical capacity at an astronomical rate.
The expansion metrics are relentless, and they have to be. OCI now operates 147 live customer-facing regions,
147.
and they have 64 more regions planned.
So they're planning a near 50% increase in their total regional capacity.
Over the next few years, yes. And just in Q2 alone, they handed over nearly 400 megawatts of data center capacity.
400 megawatts in a single quarter is a staggering amount of power. I mean, that's enough to run several major cities. That kind of build-out implies an operational machine working at maximum efficiency.
It absolutely does. And this isn't just about general data center space. It's about deploying highly specialized, high-density AI hardware. They also delivered 50% more GPU capacity this quarter than they managed in Q1.
Which shows that the logistical bottleneck is easing up.
Or at least they are rapidly getting on top of it.
And what about the cutting-edge hardware itself? Are they locking themselves into one specific supplier, which feels like a major risk in this supply-constrained environment?
That is a fundamental risk they seem to be strategically mitigating. They are heavily committed to the latest tech, yes. The centerpiece is that massive supercluster project in Abilene, Texas.
The Blackwell project.
It's on track to deliver over 96,000 of NVIDIA's top-tier Grace Blackwell GB200 chips. But, crucially, the sources highlight that they also began delivering AMD MI355 capacity to customers this quarter.
So a multi-vendor approach.
It's essential. It's for managing supply chain risk and ensuring they can serve customers who might prefer or require alternative hardware.
Okay, delivering 96,000 chips and 400 megawatts of power requires just unparalleled operational rigor. We heard about a very strict process for even accepting contracts. It's not just a sales team saying yes to everything.
And this is the operational moat. They only commit to deals when 7 essential components are rigorously aligned.
7 components, what are they?
They have to analyze the land availability and power for the data centers. They need guaranteed component supply GPUs, networking gear, all of it. They assess labor costs, engineering capacity, and finally, a favorable capital investment model. The key is they only sign the contract when all 7 elements are verified.
Which ensures they can deliver on time, maintain quality, and secure their profitability.
Exactly. It sounds less like a cloud company and more like a massive, globally synchronized construction and logistics firm.
It really does. But I have to ask, how does coordinating all that, like securing 96,000 specific chips and labor across continents, how does that translate into a competitive moat against rivals who might be a bit more, fast and loose?
That coordination is the moat. When a competitor accepts a deal speculatively, hoping the supply will just show up later, they're introducing huge execution risk and margin compression.
They're gambling.
They're gambling. By rigorously aligning all 7 components, they are guaranteeing profitable delivery. And you have to remember, building these AI facilities is way more complex than standard data centers. You need liquid cooling, immense power, specialized networking. By mastering this complex supply chain, they are ensuring they're the only ones who can execute on these massive contracts quickly and profitably.
And we have some real-world examples showing this infrastructure handles peak load reliably. Tell us about the Uber and Temu wins.
These are major resilience tests. During Halloween, Uber running their high-traffic real-time application surpassed 3 million cores on OCI.
3 million cores. That's a huge volatile workload.
It is. And similarly, Temu scaled to nearly 1 million cores for their critical holiday shopping period, Black Friday and Cyber Monday.
So these examples demonstrate that OCI can not only provision the capacity, but also handle these sudden, massive operational spikes, which is absolutely crucial for any business where a failure means instantly losing revenue.
Exactly. And to wrap up the infrastructure discussion, there's a critical architectural choice they made years ago that gives them massive flexibility in this volatile AI market.
You're talking about fungible capacity.
Absolutely. This goes back to their architectural foundation, bare metal virtualization combined with secure wipe capabilities. Unlike traditional cloud environments, OCI's use of bare metal allows customers to dedicate hardware resources, including GPUs, directly to their workload without a performance overhead.
Which is vital for AI, where every millisecond counts.
It is. So if a customer signs a massive contract for a specific set of GPUs, but then changes their mind or scales down, they aren't stuck with that idle capacity.
Yeah, they can just reuse it.
Precisely. The fungibility means that using their secure wipe technology, they can reallocate capacity from one customer to another in a matter of hours.
In hours. That's incredible.
In a market where customer needs are changing so rapidly, this is a massive operational advantage. It allows them to confidently accept contracts, knowing that if any resources become available, they can be immediately provisioned to the next waiting customer.
And those customers adopt that new capacity very quickly.
Incredibly fast,
Yeah.
typically in just 2 to 3 days.
The scale of this AI operation brings us inevitably to the financial reality of it all. The CapEx required is enormous. We noted earlier that CapEx was $12 billion this quarter,
Right.
which resulted in a negative free cash flow of $10 billion. And for a lot of listeners, seeing a $10 billion negative cash flow is immediately, concerning.
It is, and that's a critical concern, which is why the company spent so much time detailing their financial strategy. First, we have to understand the nature of that cash burn. The vast majority of that $12 billion in CapEx is not sunk cost.
Yeah.
It is an investment in revenue-generating equipment servers, networking gear, AI hardware, which is placed very late in the data center production cycle.
And because it's deployed late, it can start generating revenue very quickly.
Within weeks, it mitigates the cash flow drag. They're strategically deferring the highest cost components until they are almost ready to bill the customer.
That shortens the time between spending and earning.
Exactly. And they manage the even longer lead items like the land, the building construction, and the power delivery through smart leasing structures.
So they're not buying the buildings outright.
No, the expense for the foundational infrastructure base is covered via leases, where payments don't even start until the completed data centers are actually delivered.
So that structure shifts the multi-year construction risk and the cash outflow onto the lessors.
It's a very calculated way to manage the massive capital requirement while controlling that cash flow volatility.
That's intelligent risk mitigation. But even with leases, the equipment costs for 96,000 GPUs and all the associated gear remain massive. They're also deploying some novel strategies to reduce that burden, moving away from the classic CapEx model.
This is perhaps the most revolutionary aspect of their financial engineering. They are using 3 specific non-traditional strategies to minimize their borrowing needs. The first is facilitating something called customer-supplied hardware.
Customer-supplied hardware, or CSH. So that means the customer is literally bringing their own chips. Walk us through that.
That's right. CSH means the customer, say, a large AI startup, procures its own specialized chips, like an NVIDIA H100, and then brings that equipment to be installed and managed within OCI's purpose-built data centers.
And that completely eliminates Oracle's upfront CapEx for that specific high-cost equipment.
It does. It fundamentally changes the balance sheet equation for them.
But why would the customer do that? Why not just host it themselves?
Because they gain immediate access to world-class infrastructure, the power, the cooling, the security, and especially the high-speed networking, which is something they often can't replicate quickly or economically themselves. Plus, in the supply-constrained market, large customers often have preferential access or purchasing agreements with the chip makers.
So it's a win-win. The customer guarantees capacity for the chips they already have, and Oracle sheds the CapEx burden.
Exactly. Fascinating. So the second strategy moves the capital burden onto the supplier. That's supplier leasing. They are negotiating deals where the chip and equipment vendors effectively rent their chips instead of selling them outright.
That's highly advantageous. It synchronizes their payment stream with their customer receipts.
Right. They aren't paying for the chips until they are receiving revenue from them. It shifts the capital intensity from a massive upfront payment to a smoothed operational expense, tying cost directly to monetization.
And the chip manufacturers agree to this because they secure a massive guaranteed customer for their hardware. It moves them into a more stable, recurring revenue model.
Exactly. It's a strategic risk-sharing model. And only after using these two non-traditional methods do they rely on the third strategy, which is leveraging traditional debt markets.
So by using CSH and supplier leasing.
They expect to need substantially less than the $100 billion build-out capital that analysts often model. And through all of this financial engineering, they are foundationally committed to maintaining their investment-grade debt rating.
Which is a self-imposed strategic constraint that governs every funding decision.
It is.
So let's shift to profitability. When do these enormous investments start translating into profit? What's the timeline for hitting those target margins?
The long-term target is very robust, 30% to 40% gross margin over the life of an AI contract.
30 to 40%.
And because of that optimized process we discussed, buying the equipment late and provisioning it quickly, the lag time between the hardware expense and revenue generation is minimized to only a couple of months.
That's a very short lag time.
It's essential for cash conversion. So the key to reaching that aggregate 30% to 40% margin isn't waiting for old data centers to mature. It's about the mix of new, highly utilized capacity coming online globally.
So the overall margin improvement is driven by the mix of capacity.
Precisely. The faster they can physically deliver and provision highly utilized, profitable new capacity worldwide, the faster the aggregate margin ramps up toward that target.
So the message is clear. The speed of the build is directly correlated to the speed of profitability.
That's it.
So moving up the value stack, we shift from infrastructure, from OCI, to the higher value software layers, the database and applications. This is where AI gets integrated. And the vision starts with autonomous software.
The autonomous vision is fundamental. It's the idea that software should manage itself, eliminating human labor for patching, configuration, and security.
Which lowers a customer's operating costs while boosting security by removing human error.
Exactly. But the Q2 vision expanded this considerably with the introduction of the Oracle AI database and, critically, the Oracle AI data platform.
Okay, what is the core mission of this new platform, and why does it require a completely new approach to data?
The mission is all about enterprise intelligence. It is designed to enable the latest, most powerful AI models. They specifically cite things like OpenAI's ChatGPT, xAI's Grok, Google's Gemini, to perform deep, multi-step reasoning across a company's private, confidential enterprise data.
And all while adhering to strict privacy and security protocols.
Of course.
Okay, here's where it gets really interesting for our listeners. We hear constantly about training AI models on public data. Why is reasoning on private enterprise data arguably the bigger, more valuable opportunity?
Because public data is commodity information. Enterprise value resides in proprietary internal data, the customer support history, the product blueprints, the contracts, the financial ledgers.
The stuff that makes a company unique.
Right. And Oracle databases and applications already hold most of the world's high-value private transactional data, and customers are now demanding a holistic, unified view of their business. So while training on public data is a huge market, the ability for an AI to analyze a company's complete, confidential internal history will be an even larger and more transformative business.
To get that holistic view, they have to break down the data silos that plague every large enterprise. Technically, how are they doing that?
It's a dual-pronged architectural approach. First, the foundational Oracle database had to evolve. It has been upgraded into a vector database, what they call the AI database.
And that's vital because traditional databases just store rows and columns.
Right. A vector database, however, converts data into mathematical vectors that represent meaning and relationships. This makes the data immediately accessible and understandable to AI models for advanced reasoning, not just simple retrieval.
So the database is now speaking the language of the AI model. What role does the AI data platform play in synthesizing all the other data sources?
The AI data platform acts as the unifying brain. They call it an AI lakehouse. Its purpose is to catalog and vectorize all of the enterprise's data regardless of where it resides.
So not just Oracle data.
Not at all. Think of it this way. Traditionally, data sits in separate, unlinked filing cabinets. One for sales, one for manufacturing, one for support. The AI data platform breaks open all those cabinets. It catalogs and vectors data from competitive sources like MongoDB or Snowflake, from data lakes, cloud storage buckets, even custom apps.
So the platform is essentially creating a single, fully indexed library of the organization's entire knowledge base, where an LLM can perform seamless cross-referencing.
Exactly. This unified access allows the LLM to perform that multi-step reasoning. It means the AI can simultaneously cross-reference a sales contract detail with a recent support ticket and an inventory metric to derive a real, actionable insight.
Let's use the core analogy from the report to illustrate the power of this. If a business executive asks a single question today, what kind of answer can the AI deliver that wasn't possible before?
Well, instead of needing separate, siloed reports from different departments, they can ask one highly complex strategic question like, who is the next best customer I should be selling to in my territory, and what's the likelihood of them churning?
A question that would take a team of analysts weeks to answer.
And even then, it would be incomplete. The AI model then reasons across multiple, previously fragmented data sets simultaneously. It pulls sales data for upselling opportunities, contractual data for renewal dates, support data to assess satisfaction, and even public data to determine product fit.
That capability fundamentally shifts the executive's role from just interpreting reports to taking immediate, intelligent action. It's prediction and prevention, not just reporting.
That is the turbocharge effect. This unified capability, the ability to reason across all enterprise data, is expected to dramatically increase the consumption and use of the database and cloud services. It creates a powerful flywheel.
Now let's move to the fourth pillar of acceleration, the applications business. Cloud applications revenue grew a solid 11%.
It did,
But the underlying metrics and
completely independently. Now they're unified. This facilitates what they call strategic one Oracle conversations. Instead of selling a single component, the sales force is mandated and structured to sell large, multi-component deals that cover a customer's entire business.
combining that industry-specific expertise with broad ERP knowledge is a massive organizational risk, though. How do you train your sales force to maintain deep domain expertise across so many varied fields?
The risk is real. You can definitely lose specialized knowledge. But the key to mitigating this was a massive internal investment in sales enablement. While the organization is unified for contracting, they built dedicated specialists who can be brought in for domain depth, like in healthcare or financial services.
And the ultimate goal is to drive upgrades from that huge installed base of on-premise customers.
That is the single largest opportunity. Migrating an on-premise customer to the cloud delivers a massive 3x to 5x annual revenue lift compared to the support revenue those customers were generating.
3 to 5 times.
So the One Oracle structure systematically targets this highly valuable installed base, converting low-margin support revenue into high-margin cloud subscription revenue at scale.
Beyond the sales structure, the competitive advantage seems to be rooted in the deep integration of AI into the product itself. The phrase built in, not bolted on, AI is central to their narrative.
And that phrase is a direct shot at competitors who rely on customers integrating third-party AI tools. They currently have over 400 AI features live across the Fusion application suite, already integrated into core workflows.
And this is especially visible in the healthcare business.
Yes, let's focus on healthcare, which is a key growth area. The progress there is incredibly rapid, especially with their clinical AI agent. They have 274 customers already live in production on it.
274. That's an impressive number for a nascent, highly regulated field.
It is, and it's rising daily. Furthermore, they've achieved a major regulatory hurdle. Their new AI-based ambulatory EHR has received U.S. regulatory approval and is now generally available.
And what about the speed of deployment for these complex applications?
That's the true competitive edge. Deployment times for these new AI SaaS applications are measured in weeks, not the months or years typically associated with enterprise EHR or ERP deployments. Customers can often roll them out themselves with minimal professional services.
Which is a massive time and cost saver for healthcare providers.
Huge.
Okay, those metrics are powerful, but let's connect it back to utility. Can you share the customer success story of Tim Brazil? It really combines the infrastructure and the applications.
Sure. Tim Brazil, the 5G leader in Brazil, signed a 5-year OCI expansion deal specifically focused on accelerating AI adoption to improve customer service at massive scale.
And this builds on a prior migration where they moved their entire data center to OCI.
It does. The new project involves building sophisticated AI agents for customer interaction. For example, their AI agent automatically analyzes a customer's bill, compares it across previous months, and instantly provides a detailed, personalized explanation of any variations.
It eliminates a classic pain point in customer service.
Exactly, and the tangible results of that pilot were immediate. They saw an 18% faster issue resolution time using the OCI-built AI agents. Call center flows are now managed end-to-end with 90% accuracy.
And what about on the infrastructure side?
The predictive AI copilots led to a 15% reduction in network failure interventions, predicting maintenance needs before outages even occurred. It's a complete business transformation powered by that integrated stack.
And Kim Brazil is not an isolated incident. We're seeing this across sectors.
Correct. The momentum proves the efficacy of the One Oracle sales approach. We see major multi-pillar wins across critical sectors. The U.S. Space Force selected Fusion ERP and HCM. Dropbox chose Fusion ERP and SCM. Virgin Atlantic Airways went live on Fusion ERP and HCM.
So these multi-pillar deals are the direct output of that new sales structure.
They are.
So if we step back, what is the final competitive takeaway? Why are customers choosing this integrated solution over the traditional best-of-breed approach where they might pick and choose vendors?
It comes down to integration cost, security, and speed to value. Oracle is uniquely positioned as the only company selling complete application suites front, back, and middle office that are natively unified with both the AI data platform and the underlying cloud infrastructure.
And customers are just tired of this staggering integration costs and security risks of cobbling together a bunch of different systems.
Exactly. The integrated solution minimizes that pain, guarantees security across the stack, and accelerates the ability to leverage enterprise-grade AI immediately. In the current market, that is a highly compelling differentiating proposition.
As we wrap up this look at Q2 2026, we've clearly identified the three massive pillars driving this transformation.
We have.
OCI's capacity dominance, fueled by that unprecedented RPO and rigorous delivery planning.
Yeah.
Then the strategic unification of all enterprise data via the new AI data platform. And finally, the resurgence of the applications business, driven by that One Oracle selling model and deeply embedded AI.
And the forward guidance certainly reinforces this accelerating trajectory. Looking ahead to Q3, total cloud revenue is expected to grow between 37% and 41% in constant currency.
37 to 41%.
This is off an increasingly larger base, and it demonstrates a high degree of confidence that the massive momentum from those RPO contracts, combined with the successful capacity delivery we've analyzed, will continue to drive rapid top-line growth.
It really seems like they are moving into a phase where the highly leveraged investments they made over the last few years are now scaling up to meet genuine market demand.
It does. It's clear that the strategic decision to own the infrastructure, hold the foundational data, and possess the application layer creates a flywheel effect that few, if any, of the other major players can fully replicate.
Offering a truly integrated platform for the AI future.
It certainly presents a compelling view of that future, and it leaves you with a question. If the ability to reason across all private enterprise data using AI unified, secure, and available is the key to future business value, what long fragmented internal processes within your own organization, perhaps the old silos of sales, support, and contract management, will be the first to be fully unified and automated by this new wave of integrated technology? That shift from fragmented data to holistic intelligence is the challenge every modern business must now tackle.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.